all you.
All right. So again, hi everyone, and so all guests, and of course, I'm Alan. Welcome to here at Manabu Hubs and the community lead here. We are so excited to many of you here today for our second session as part of the Startup Cloud program. And this is what it's all about, like, of course, connecting directly with the expert who can help us today. And today, we're kicking things off with a session on investment preparation, funding, and valuation. And of course, this is a topic I know many of you are eager to learn about, and we brought in the perfect person to guide us today. And of course, our session will be recorded for those who cannot attend and will submit on our YouTube channel as well. And before that, our mentor is Maria Noel de la Paz. She is Acceleration Director at Magical. And Maria Noel, thank you so much again for joining us. And we're already ready to excited to learn from your insight. And the floor is all yours. And before that, we would like to invite Pablo Rivero as founder give some remarks first before we initiated our session today.
Thank you, Alan. I really appreciate that. And again, thank you so much, Maria Noel, for accepting our invitation to learn from you, your experience as a director of this venture capital from Chile, but also your experience in Asian market. I know that you are in Korea, and I think you've been also very often traveling into Japan. And I think all your insight, your experience, meeting. I know that you participate in many venture capitals events, globally events. So that would be very fantastic opportunity for all of our founders and startups in our ecosystem. Before to start it, I would just briefly introduce about Manabu Hubs. And Manabu Hubs started as a community from founders to founders, I call it, in which this community started expanding into a global incubator. And the incubator now we have expanded in 3 countries. We started in Australia. Now our headquarters is in Japan, and we also have recently and a new in Taiwan. In Taiwan, we have a digital hubs in Fukuoka, in Taipei City, but now we have a physical hubs in Hualien City. We partnered with a new space in the cloud hubs. So we are very excited to expand our operations globally. And then we are having so many founders actually reaching us for expanding operations in Asia. Some of the founders moving from Finland to Japan, but also expanding in Southeast Asia as well. So Fukuoka is getting super popular, has a base of entrepreneur ecosystem. So again, thank you so much. And if you want to know more details, Alan in the end will explain more about how you can reach us and contact us. So please, Maria Noel, sorry for interrupting. It was a short introduction of us, but we are all about learn more from you. Thank you.
No, hi everyone. It's such a pleasure to be here with you today. First of all, of course, Pablo and Alan and the Manabu team, thank you so much for this kind invitation. I prepared a presentation for today, so it could be easier to navigate through the topics. But first of all, I would like to introduce myself. My name is, my name is Maria Noel de la Paz. I'm originally from Uruguay in South America, and I'm currently based in Seoul in South Korea. I work as the Acceleration Director at Magical Startups, which is a venture capital fund and accelerator from Chile that invests across Latin America. Before that, I also was part of SeedStars. That's a Swiss company that focuses on supporting and investing in startups across emerging markets through investment and programs. And my very first steps in this startup world was at Startup Chile. You might have heard about this program. Is the first government program in the world that designed to attract and accelerate global startups. And also for the past 2 years, as Pablo mentioned, I've been researching and also building connections between the Asian startup ecosystem and the Latin American ecosystem. And through this consulting work, I support founders from LATAM that are looking to enter East Asia, as well as Asian startups that are also interested in exploring Latin America as their next step for expansion. So before we dive in, I would like to know if how many of you have already raised a round or received external capital. I don't know if Giovanni or Nat, if you've experienced that before. No? Okay. Perfect. That's perfect then. So today, I'd like to share three main things with you. First, we're going to talk about funding, what it means, the different types that exists. Also, investment preparation, what you should have ready before you meet the investors, and investor mindset, how investors think and what they look for, so that you have that in mind when you start doing the research and the fundraising. And finally, we'll have some Q&A. We can make it practical with your own cases. Okay, let's go. So funding. Let's start with fundraising. Fundraising, it's not just looking for money. I believe fundraising is focusing on finding smart money. When you raise capital, you're not only simply receiving a check, you're also choosing partners who will join you on your journey. And the right investor is not only someone who will provide you money. You should also be looking for someone that also brings value to your vision, connections, industry expertise, market knowledge, if you're thinking about expansion or credibility, and also and mainly support when things get tough. That is why I always advise founders to really focus on the match. Because I've seen cases where a poor investor relationship can really create unnecessary stress on a already very challenging path that you have ahead. But the right investor can really open doors to markets, to talent, to opportunities you might have never reached alone. So when you think about fundraising, think of it as if you were building your team or your advisory board. You're not only pitching for capital, you're also evaluating whether this fund or this angel is truly the right partner for your company. So let's talk about the main sources of funding available for startups. First, you have bootstrapping. This means using your own resources to build your company. Many great businesses started this way and chose bootstrapping as their main strategy. For example, MailChimp, that you might probably know, they were bootstrapped for years before it was sold for billions. So they never went on the raising capital route. They kept bootstrapping. It's also, of course, it's a challenging path, but some founders feel much more comfortable this way because they have the resources to invest themselves at the beginning and later. And also they can support their operations and expansion themselves. And they gain total ownership of their own company. Of course, that the main downside of bootstrapping is that it can limit the speed of growth compared to maybe your competitors or other people that are fundraising at that time. But it really depends case to case and founder to founder. I think it's a very personal decision for each CEO of how comfortable they feel with bootstrapping. But in the portfolio of companies of Magical, for example, we have there are some founders that decide to bootstrap, and they're very happy with that path. Then you have your friends and family. Before it was called FFF, family, friends, and fools, or fans. And I prefer fans than fools. They are the first people that believe in you. It's more of emotional money. They trust you more than the business model. And usually they are the first small checks and a way your close networks really validates your vision. It does carry some risk as well, because as you know, not all startups will succeed, and that can affect personal relationships. But at this stage, it is very important to be transparent about the roadmap and clear about what could happen, especially for those who are not in the startup field that are part of your network. But I've seen this first step. It's pretty common to have your first tickets of your own network of people and support. And then you have grants and government programs. You probably are familiar with this one. Around the world, there are many programs founders can apply to. In Chile, for example, as I mentioned, there's Startup Chile, there's Station F in France. Here in Korea, there's the K Startup Challenge. So there are many, and most every country nowadays have their own version of a government program to invite foreign startups to get into their country and expand their business. And also public funds as well. I know in Japan there are subsidies and public funds that support innovation. This is excellent money at the early stage because it doesn't dilute your equity. And you keep your ownership. So grants can really help you validate your idea, reach your MVP, get your first customers, and with a lower risk for yourself and your financials. So for startups in early stage, I usually highly recommend this, especially when they are interested in growing to a different market and they don't have the resources yet to map these different programs and the different grants. It's something that I highly suggest. And then we have the angels. These are individuals with capital and experience who take really early bets. They might be former founders, industry veterans, LPs from like large funds that want to invest individually. And angels specifically, they don't just bring money to the table. Also, they provide mentorship, advice, valuable connections. Some even get hands-on involved in your company. So I've seen angels supporting sales or getting into operations. And it really often goes beyond the ticket size. So also with angels, it's very important to really be on the same page, and they are great assets to the company at the first stages. And then we have the VCs. It's more institutional money, and it comes from it usually comes when you already have some traction to show. VCs invest for growth, for scalability, and they want to see that your company can become big fast. There are different kinds of and types of VC funds. Some are more early stage, other focus on later stage. We will look at that more closely later. But yeah, venture capitals are also interesting to consider when you are doing your fundraising, depending on the stage you are at. And then we also have the CVCs, corporate venture capital. These are companies that invest because your startup aligns with their future strategy. Today, we see more and more corporate VCs active in the ecosystem, scouting for synergies and innovation that complement their operations or the pain points they are having right now. I don't know how it is in Japan. I haven't been doing research or updating myself lately on how CVCs, but I imagine that is also a trend that is happening in Japan as well. In Korea, it's growing, and in Latin America in general as well. So that is something that is also interesting to be mapping. So each of these sources is different, and not only in the money that they provide, but also in the expectations they're going to bring and the kind of relationship you will build with them. But as I mentioned, not all these sources appear at the same time. They tend to align with the different stages your company is at. So this is what this graph is showing. This is a startup financial cycle. And it maps how funding sources typically match each stage from the very beginning, like the co-founders or early angels, and all the way up to the IPOs and the public markets. So this is an interesting graph to consider. And each stage, it's very important to know exactly who to reach out to. So now let's talk about investment preparation.
Sorry to interrupt
Yeah,
you, Maria, but it was very interesting to see the valley of
yeah,
death.
yeah, yeah, yeah.
It was like, kind of, oh my God, so if you don't pass this ballet, it's you are survive, right? If
Yeah,
everything
that's
you
that's the
survive.
tough one. Yeah, that's exactly
Yeah.
that's the tough one to pass,
Mm,
right? And yeah, I mean, the value of death, it's when you are spending money but you're not having your revenue yet. So it's a really challenging part, because the survival really depends on your own resources or very early support. And that's why at that stage, the funding usually comes from the co-founders, from the friends and family, or more seed capital. There's also some accelerators that, of course, like invest at that age, at that stage, which is really important, because accelerators also will give you the tools and the support in, okay, how to deal with different challenges that you're going to face there, and the experts and the mentors. So it's really good to take those different resources in that stage, because yeah, that's the reality, is that more than 70%, I think it's like 80% of startups are not going to go by the value of death. That's the status of like the regular status from Silicon Valley ratings. But yeah, that's an interesting stage. That's the interesting stage to give it all. But yeah, but so yeah, but it's important to know all the resources that you have, so that you can survive that. um, so how do we prepare ourselves for investment? And I think the most important thing, or the starting point, is understanding exactly what stage you're in, what your expansion strategy is looking like, and most importantly, why exactly you need money for. Because sometimes founders, and I've had these conversations with founders before, they're like, oh, we're opening our next round. And it's like, okay, how much money, like how big will be the round? And they're like, oh, $1 million. And it's like, okay, like why? I was like, well, yeah, but they don't know exactly why they are why that is the range that they're looking for. And that is risky, and that I don't recommend. So you should build a cash flow projection that shows exactly, or at least like a range of how much money and how much capital you really need for the next 12 to 18 months. That's like the standard. And here, for me, really, I want to highlight the important thing, that do not raise more than you need, because you will dilute unnecessarily. I'm talking about VCs, and also don't raise too little, because then you'll be back fundraising again too soon. And fundraising is a very energy consuming process. So the more efficient you can be, the better. So that is really important, that you take your time to prepare, and to have your cash flow projection, and to go into numbers, get the support that you need, either from your network, your accelerators, your mentors, your board. Like there's always someone that is going to help you with the financials, or your CFO for sure, if you have one. And really do that projection more precisely as possible to what you want to do and what's your vision for the next 12 to 18 months. And once you have clarity on your round, the next step is to do your research and do a deep dive. And this is, I think, is as important as the first step, is deep dive to identify exactly the funds or the investors that could be a good match. Look at their investment thesis, their average ticket size, the industry they like, their past investments, and even ask for recommendations from other founders. That is usually, most VCs, they have their portfolio like available for anyone, so you can look at them and see like what other investments they've done, and maybe some of them, and ask them how the experience has been. and that is critical. The word of mouth is in the VC industry. It's very, very important that you know exactly what you're going to get from that relationship and that investment. And this is the moment that you really need to understand who you want to partner with. And after that, once you already have them mapped out, I recommend organize this with a CRM. And it's you can do it in a simple spreadsheet. I recommend doing it in Notion, in a Notion board. I'm Notion fan, so I use Notion for everything. But there you can organize your list of funds and investors. You can keep track of who you've contacted, their feedback, the stage of each conversation. Fundraising is mainly it's the same as a sales process, so you can look at it as a sales process, and you need to manage it as one. It's very important to keep track of every conversation, and because you're going to speak with a lot of VCs in the fundraising stage, and you need to track all that information for this round, for future rounds, for it's very important and critical. And I think it's a good practice from the startups of my portfolio. They usually have a really, really clean track, and the ones that don't, they struggle, and it's, I don't think it's a good practice for them. And in parallel, you can build your pitch deck. I'm sure that most of you already are used to having your pitch deck, maybe for competitions, for presentations, for sales, etc. Think about that this pitch deck is going to be who your audience will be. These are venture capitalists, or these are angels, or these are, people that are interested in investing in you. So it's very important that you keep focus, of course, on the main things like problems, solutions, team, the why, the vision. But it's important that you mainly focus on numbers, like the market, the traction, and all the things that will validate that this is actually a business that will grow eventually in a fast pace. So that is important, that if you already have a pitch deck, that you go over it and think about it and redo it, thinking of what the VC wants to see. And we're going to talk about that later, but just keep that in mind when you're doing your pitch. And also, I recommend, besides of the pitch deck, I highly recommend doing a data room. This is something that it's more and more common. Before, maybe like 6 years ago, 7 years ago, it was more common to do the shared folder. And it was, but I don't recommend that because it's a bit of a mess. So now we have a lot of tools that we can help you, like Notion, for example, Spaces, etc., where you can keep all the documents, like your cap table, your financial projections, your key contracts, and other supporting material. And you can keep updating that as you grow. And it shows like really professionalism when investors ask for more details. So you have that, and it's a really, really good thing to have besides of your pitch deck. And finally, when you have all this, you start reaching out and try to reach out for the investors. Of course, warm introductions are better if possible. So if you already know someone that can introduce you directly to a fund, it's the more ideal path, through your mentors, through your network, other founders, etc. But if not, you can always go for cold introductions. They work too. Especially, I would do that to the fund scouters, the scouting managers or directors, that they are the ones that are looking for new pipeline. So I would target them mainly. And participate in events where VCs gather. For example, here in Korea, there are so many events, and in Japan, I know there are many events too. And I know Manabu also makes a really good events to get more and more connections with VCs and funding, etc. So like participate in those different communities to also get to know more people that can help you out in that process. And one more thing that for me is important to mention as well, for especially with relationships with the VCs, is the keep investors updated. Even if they didn't invest in you yet, send a short investor update every quarter at least. And I think it's a very powerful way to stay on the radar, on top of mind of these investors. It doesn't need to be long. It can be just a simple email with your main achievements, your key metrics, your milestones, your challenges you're facing, and your next priorities. I think I receive a lot of them, and I think it shows really transparency from the founder, discipline. It shows progress, and it also helps to build trust in each other. It's not like, oh, I sent you an email when and I'm expecting like a relationship to grow, but this is like something that grows during time. And some investor might say no today, but maybe in 6 months it's a yes, simply because you've been very consistent. You've been showing your growth through your updates. So I think that is something to keep in mind. I know it's hard because you are already like CEOs, founders, you're doing so many things at the same time that adding like, I also need to update investors, or I need to be updating people on our progress. I know it can be like challenging or not top priority, but trust me that is something really, really helpful when you are going to open up your next round, or even for connections, for business connections. Like it's a really, really good thing, and I highly, highly recommend. These are some tools that I share with founders sometimes. I'm gonna later send this to Alan and to Pablo in case you guys want to check out like some of them. It's a collection of templates, of articles, resources that can help you on the different stages and the different things that I mentioned before. There's a cash flow template. There's a data room template. There's a fundraising tracker template. So like everything that I mentioned, you are covered. Like if you want to proceed and continue in building those things for your next round, you have tools here that will help you to do that. So yeah, it's a bonus track for you. And finally, let's talk about, I don't know if there are any comments or any doubts on the prior section before we go into our last section. Any comment? All good? All right, cool. Okay, so finally, let's put ourselves in the shoes of investors. And let's remember that they're not just giving money, they're also taking a risk and betting on you. So what do they really look for? As I mentioned before, we are looking for high potential. They want to believe that this startup is going to return 10 times or even 20 times in the next 5 to 7 years. That's the business model of a venture capital fund. And that doesn't mean every company will, but if the potential is not there, they will probably won't invest. Venture capitalists, we know that not all the companies are going to succeed. We know about the valley of death. We know about like how markets work. We've been in this industry for a long time to know that, yeah, if we do 10 investments, probably maybe 4 will be successful. So yeah, but we are trying to reduce the risk as much as possible and to look for that high potential. A second, it's very important we look for clear unit economics. This depends really on the stage that the VC fund invests, but usually even early stage, like we look for a path of sustainability, and also that the founders are also very clear about what they're doing. So, for example, unit economics like the cost of acquisition of the customer acquisition, lifetime value. The investors really want to see that numbers can make sense at scale. So I've seen founders that they don't have clear those numbers. So it's very, very important to show that you exactly know how much it's costing you to have a new customer, or the different like star metric that you have in your business. That's very important that you are clear about that. And then there's a scalability as well. They want markets that are big enough and growing, and also a team that can actually capture that growth. I think the team is key. Because ideas and businesses, there are many, but people that can execute and can really do and be in this difficult race of achieving something disruptive, and having that goal and that vision, and execute accordingly. That is not easy to find. So yeah, there has to be this founding team be strong and resilient and have complementary skills. Is often one of the key factors. At least at Magical, that's one of our key factors. We look into, we have so many meetings with the founders because we want to see that it's a good match, and also that the founders have the right vision. I've seen so many founders so far that I already can tell how that if the founder has the right eye or the right one to execute their vision. So yeah. And now I would like to share some red flags that you might get trapped into these before. But it's important that you know that these are some things that we look for and that we are seeing as red flags for us before investing. One is overvaluation without traction. If you're asking for a very high valuation, but you don't yet have real results to show, it really creates doubts. This, especially right now, because we are in, the winter of BC, the economy has a recession, and it's very different setting and scenery from what happened maybe in 2020 or 2021, where there was like a peak of investment and money was like flying around everywhere, and valuations were to the roof, and that with someone with a PowerPoint was like raising a fund with a valuation of like, I don't know, $5 million, which for us in Latin America is something that it's no. But in Silicon Valley, some people actually really got high valuation investments. But now I think everything is going back to normal, and valuations are back in like normal ways of finding your valuation that is a true valuation. In a very early stage, valuation is more an art than a science. Sometimes there isn't just one formula to know exactly what your valuation is at this point, but there are a few methodologies founders and investors use as reference. I think the most common one is the comparable multiples. I don't know if you've heard about this one, but it's you look at similar startups in your industry and region and their valuation, and then you adjust accordingly in terms of like how many clients, in terms of like different multiples that you work with to adjust to your own valuation. And this is a good way of showing, and because a VC can say, well, but why is this your valuation? And then you can show like the exercise that you did and agree on the valuation. Sometimes it's negotiated even probably at early stage, valuations are negotiated. But then once you have your first investment, then your valuation is set, and then it's much easier for the next round. There's also the venture capital method. It's estimates a potential exit in value in 5-7 years, and then it works backwards to see what valuation makes sense today. That is a little bit tricky one. So I would recommend for the comparable multiple ones. And yeah, there's always people that can really support in helping finding that valuation, or they're experts in that area that can help you out for sure. And then, well, messy cap tables. This is a big issue. And you will say, oh, it's not a common thing that you see. I see messy cap tables more than I would like, to be honest. If the ownership structure of the cap table is too complex, or if the founders don't have enough equity left, investors really worry long-term alignment, to be honest. So really keep it simple, especially in the early days. Avoid giving away small percentages to too many people, and protect the founder equity as well. By the time you will reach your Series A, hopefully your founding team still has more than 60 or 70%. And an important issue I want to bring up, because I see this a lot as well in cap tables. Think carefully about your co-founders. I've seen really very limited situations where the company is doing really good, and the traction, the business is doing great, markets are needing of that product, but because of problems with co-founders, and some co-founders that decide to leave after 4 or 5 years, they want to do something else, etc., but they stay in the cap table. And before, there was not usual to have different protection on that. So like you kept someone with 30% that was not active anymore in the business, and that makes a lot of noise. And so nowadays we've learned, so if you start with partners, make sure the equity is divided fairly based on commitment, not friendship or necessity, and always have vesting arrangements in place. That way, if your co-founder leaves early, the shares don't remain locked in forever, or there's like legal battles that they're a mess, and I wouldn't go that route. So a clean, balanced cap table shows professionalism, makes investor feel confident that you are aligned for the long run. So highly recommend that. And finally, of course, the lack of founder focus. This is kind of obvious, but if a founder is running like multiple side projects, or vision is not clear, it will raise concerns of the execution. So investors are looking, as I said before, for commitment. So that is something that would be a big, big red flag if you are the CEO of your startup and you're also working for a company that doesn't work out. So yeah, those are big red flags. I saw that there was like a hand somewhere. I don't know if we wait
Yes.
to the end, or we have a question, or I don't know.
Hi, I have
I
Maria Noel.
Yes.
Well, thank you so much for that, and sorry for the interruption. My question is actually, these questions are gathered before, and especially from other founders. They ask question, and then there's one founder would say that, what are the top 3 mistakes you see founders make in your pitch decks, and what single slide or piece of data is most crucial for you to see in a first meeting?
Mm. Well, I think one of the mistakes that what the first one was, what the 3 main mistakes.
Yes. What are the
Yeah.
top 3 mistakes you see?
Mm. I think for pitch decks, it's important to one of the mistakes I see is that founders don't put enough numbers. It's more like the vision, or and like what they've done so far, but there are no specific like data that supports exactly the validation of that business. So I think more numbers, it's something that I usually see as missing. Also, there's usually missing the roadmap. For example, like what the projection is, like, okay, we started doing this, now we're doing that, this is where we're at, and then this is what we're going to do, like what they're planning next. Sometimes that is omitted, and that is very important to see exactly what they're planning on doing next, to see if we want to be on board on that, or that is the correct like step to do that. And another one is sometimes they omit the team, which is, for me, is critical. Like, who is behind this is very, very important. And when we say the team, also it's important to add who's the advisors, who, you know, if you have like a network also of people that already validated you, it's important to incorporate them. And I think those are important. And sometimes also I would have like a bonus mistake is not to include the competition. Sometimes founders don't include the competition because maybe they don't want to, I don't know, they don't know how to present it, or they are not that clear of who their competition is. And that's why I think putting the competition in is so important. First, because it shows the investor that you already know exactly who is your competition. You're mapping them out. You know who they are. You also know why you're better than them, because usually these graphs have exactly what your differentiation is from them. And third of all, it also validates, if you have competition, then it's a market, it's real. There's people that, there's not only you, there's also a validation of other people that they're seeing this as a business. So I think those are the main mistakes I've seen, or the critical omissions that I see in pitch decks.
All right.
And
Well,
the same for the second question. I think those are very important to have on a first meeting, to have those things very clear. Yeah.
well, thank you so much, Maria and Noel. I believe this will really a great help, especially for an investment preparation. But before that, I want to ask Giovanni and Nat if they have a question about investment preparation.
Mm.
When do
Uh,
you? Oh, sorry.
go ahead.
You go first.
No, I think my question more on other topics, so you can go ahead.
Okay. Like, when do you think is the best time to stop bootstrapping? Stop bootstrapping says, like, in your experience, it's like, okay, this is the time where it's like, we have done it until now, and now it feels like we should do investment.
Well, I think the projection, the financial projection, helps you a lot. Even if you don't have, if you're not thinking about raising money, having a financial projection is really key to know exactly when you are going to be in trouble financially. So I think that can give you a lot of lights of, okay, like, we've bootstrapped, but maybe it seems like it will be too complicated from now on. If you want to expand and maybe include, like, add people to our team or expand to this market, etc., it's going to be such a heavy load financially, and maybe we cannot do it. So maybe that's when the conversations of finding the right partner for the next step could be interesting to have at that point. Yeah, I highly recommend doing that financial projection, because it will help you out with those kind of strategic decisions too for the business. Yeah. Okay. Well, I only have one more slide also. So for the end of the investors, and I think this is a very important part, because it's building the relationships with the investors, and I think it's the most important part. My advice is, do not wait until you're desperately needing money to approach investors. Maybe we can connect with your question, Giovanni. Start building connections early, even though if you're bootstrapping, even though your strategy is different right now, but reach out anyways and ask for feedback. You can share updates every few months. Over time, they will follow your progress. And as I said before, building trust is very, very, very important, because at the end of the day, a lot of investment decisions are not only rational. There is some emotion too in making those decisions. So investors want to trust the people that they are backing. And this is what, when I did my research in Japan specifically, and I talked to some venture capital funds, they mentioned the importance of the trust and long-term relationships there, that they are fundamental. So it might take time. That's what they told me. Like, it takes time, but once an investor decides to back you, they'll likely stay with you for the long run. And that is the kind of relationship that you want to build. So raising capital is not only about convincing investors. Remember, it's about finding the right partner and cultivating that relationship that will help your company grow. And that is the most important and key thing I wanted to leave you with. So yeah, thank you so much. I hope this helped you guys, and I'm open for Q&A if you have any questions.
Hi.
That's such
Hi,
a
Maria.
fantastic presentation. Thank you.
Pablo, you want to go first? Or,
No. Please go ahead. Sorry.
hi, thank you for the presentation. I think Giovanni just stole my question. But at the same state that well, no, I don't know about Giovanni, but I myself is bootstrapping, and I don't have any plan to raise any money anytime soon yet. But so this question are more out of curiosity. And you already answered some of the part, but I'm curious, what are the reasons that they raise the money for? Aside from they running out of money and they need money, but what are they expanding the team, or why do they need the money?
Okay, you mean the founders? Why they decide to raise
Yeah.
money? Yes,
First.
Yeah, usually the key reasons why it's first, because they need to expand their team. They got to a stage, and what I've seen is usually when they are doing they validate, like when they do the product market fit. Okay, they already know there's a business, there's some tractions, there are users, so they're early stage, but now they need to grow faster. And why is that? It's because like there might come competition, and if they're not growing fast, then like the competition can, like, I don't know what the word is in English, but they can advance them. So sometimes it's to keep up and get the pace faster. So that's why it really depends on what you're doing and what you're solving. So, but usually it might be to get faster to the vision that they already have. Mainly is for team, building a bigger team, in having more tech people in it, so that they can build faster what they're needing. Sometimes also it's for they already have the team, they already have the technology, but now they need to go faster in selling. So usually also is for marketing reasons. So they need to focus on sales, and they need to grow their sales department, because maybe at the beginning it was just the CEO that was doing the sales, but now he or she needs to have a proper team that can help them to reach out to more people, and to so that's why they raise money to build those different teams. Those are usually the reasons why. Or there are also another reason is because they're expanding to a different market. So, for example, I'll give you an example. One of my startups is in Chile, but now they're interested in growing to Colombian market. So what they do usually is they prepare the round, and they already know around how much money it costs for them to expand in locally in the first steps of the business. So they know the costs and everything. So now they kind of know, or they're trying to figure out, like, okay, like if I want to expand to Colombia, start my business operation, etc., I know around how much it's going to be. So they try to find a VC, and a good thing to do is to find a local VC. So this is what actually I support some founders in connecting with VC funds from Colombia, for example, that will be interested, because they will also give them the network, they will give them the know-how, they will have also a lot of information for them to reach that country with more, with more support, and it will be a better soft landing. So that is sometimes they do fundraising also when they're expanding to a different market, to have that smart money, not only the money but also the knowledge of that VC that will help them. And it's a win-win situation, because if the VC from Colombia, they invest in you, they want you to be successful. So they're going to try their best to do that. And that is why you need a really good partner that has that in mind. It's not just, I give them the ticket. That there's some funds that are like that as well. They give you the ticket and you never speak with them anymore. But I recommend to go with the funds that give you more just than money, because there's also a lot of connections that they're going to have, and a lot of support that it's very, very important, especially in critical times. Like sometimes it's not when you are like the going great, but when it's challenging times, you can get a lot of support from your partners. They're your partners now. They're in it with you. So if you lose, they lose. We all lose. So yeah. So yeah.
Right. I have one more question. I think this more related to your background about the cross-country funding. So I'm curious how it worked out, because normally in the business world, it's hard to just transfer money to someone, and you have to do all the accounting and everything else. And in this case, do you need to, let's say I want to raise fund in Japan. Do I have to set up corporation in Japan, or now I'm outside, I'm in Thailand?
Yeah, I don't know the specifics of how I think each fund has its own regulations on that. For example, the fund that I work for, no, you don't need to have a company established in Chile to transfer the money. No, like for example, we have startups from Colombia, we have startups from Argentina, etc., and they do not have headquarters in Chile, they do not have operations in Chile, and we transfer to Colombia or to Argentina or to wherever. So it really depends on the VC, I guess. But I think that government programs like these accelerators or like government funds, etc., I think they request, because their goal is to have more businesses in the country. So that's why sometimes, most of the times, they ask to have settle your business in that country. But with venture capital funds, that's not usually the case. And before, like most of the companies, they had a company settled in Delaware in the US. That was like the typical thing because of tax stuff. And yeah, the funds would directly invest in those. So like, yeah, it really depends from fund to fund. But in the case of the fund that I work for, and a lot of funds that I know, you don't need to be established in one country. They will transfer to your company account wherever. But as I'm saying, like it really depends on each fund's specifics.
Thank you. That's very clear to me.
You're welcome. Okay, well, thank you very much, everyone. This was really fun. And of course, if you have any further questions or anything you need, if anything comes up along the way, or you need the tool set or whatever, like please, at the beginning, on the beginning of the slide, there was my LinkedIn. You can connect me there. Pablo, Alan, also I'm on Discord as well. If you need to connect with me, I'm part of the community at Manabu too. So yeah, happy to support you in your fundraising story.
Well, thank you so much, Maria Noel. And of course, thank you to everyone who joined today's session with Maria Noel. And of course, big thank you to Maria Noel for sharing her expertise and valuable insight about investment preparation. And actually, it was an inspiring and enriching discussion for our community. And just to inform you, everyone here, we also have a third session for the upcoming September 25. That would be demo pitching, crafting your pitch with our mentor, Pablo Riveros. That will be same time. And of course, Thank you, everyone, for here for all your support. And of course, I will give you time to Sir Pablo for her. I mean, for his promote for the event for the upcoming October 9.
Thank you, Alan. Yes, I briefly reminder to the members and people who want to watch this Tutu announcement. We are hosting our big event in October 9th from 4 to 8 p.m. We become part of one of the official side event by the Ramen Tech in Fukuoka City. So it means we could have a strong attendance by founders and entrepreneurs and digital nomads that they will be in Fukuoka City. So we will be happy to invite you to joining us. We will put in our YouTube channel the subscription, the link to sign up to this event. And yeah, this is exciting event. We will have some ramen, sorry, some paellas, networking, and it's gonna be really exciting event. We have some light talk founders like I know Nats will attending, presenting as well, and we have other key speakers as well from Taiwan and Japan. So looking forward to see you all.
And also, again, thank you to Nat and Giovanni and to our mentor, Maria Noel. Thank you so much. And of course, to Sir Pablo, I hope you have a great day and enjoy the rest of the day. Thank you so much, everyone, for the live session.
Thank you.
Thanks, everyone.
Bye bye. See you.
Thank you so much. Alan, excellent.
Hi,
Well
sir.
done.
So I
Yeah,
need to
well
turn on
done.
the video because if I turn on the video, it seems like the connection is getting slow.